As we look at the board right now on Friday, June 12th, 2026, Navitas Semiconductor is sitting at a live intraday price of $22.21, marking a massive 8.34% surge in today's trading session. This volatile swing follows a brutal 10% drop just 2 days ago during a broad semiconductor sector sell-off, which itself came on the heels of a massive 20% spike last week when the market learned about their official collaboration with the NVIDIA ecosystem. While retail traders using their favorite Robinhood app or checking stock quotes on their preferred investing sites might think this sudden recovery is just a standard bounce after getting oversold, the reality under the hood reveals a much more intense institutional chess match. Wall Street is currently caught in a massive tug-of-war regarding whether this tiny wide-bandgap chip designer is actually going to pull off a multi-billion-dollar pivot into high-power artificial intelligence infrastructure, or if its crippling lack of current profitability will drag it down before those long-term contracts can ever hit the balance sheet. When you see a stock bounce nearly 9% in a single morning, the common expectation is that some massive new fundamental catalyst just dropped, or that institutional buyers are aggressively flooding the tape to accumulation shares. The general belief surrounding Navitas Semiconductor is that because they were officially highlighted as a key partner in the NVIDIA MGX platform ecosystem at Computex just days ago, they have secured a direct ticket to hypergrowth. Everyone loves the narrative of a small-cap hardware vendor riding the coattails of giants, and retail investors look at names like the NVIDIA stock, Tesla stock, or Apple stock and assume that any sub-$30 player connecting to that network is a guaranteed home run. But if you look deeper into the actual mechanics of the chip market, the reality is far more complicated and hazardous. Insiders have dumped over $117 million worth of shares over the past 3 months alone, with absolutely zero insider buying to match it. That massive insider liquidation tells you that while retail investors are buying into the hype on their Robinhood stock trading accounts, the people running the company are aggressively taking chips off the table. This massive disconnect between retail enthusiasm and corporate insider behavior creates a fascinating psychological tension that defines the entire trading profile of this asset right now. To understand why the stock is experiencing such violent daily swings, you have to look at the recent trading volumes and the macroeconomic pressures squeezing the entire sector. Over the last few sessions, volume has consistently spiked well past 23 million shares, far outstripping normal structural liquidity for a company with a $5 billion market cap. This tells us that high-frequency trading desks and quantitative institutional funds are actively using this ticker as a high-beta vehicle to trade the broader volatility of the Philadelphia Semiconductor Index. When geopolitical tensions or macroeconomic data points cause a broad tech sell-off, small-cap names with high price-to-sales ratios get hit twice as hard. Navitas is currently trading at an elevated price-to-sales multiple of over 100 times its trailing 12-month revenue, a staggering premium that forces it to behave more like an options contract than a stable equity asset. For an individual choosing self-investing through a standard individual brokerage or utilizing automated asset allocation tools like Schwab Intelligent Portfolios, this extreme volatility makes the asset an incredibly tough hold. It requires a deep understanding of hardware engineering trends and power architecture, rather than just looking at a generic chart on a Fidelity mobile app or relying on a robotic SoFi robo-advisor allocation. Let us unpack the actual structural shifts that triggered the recent 20% spike, followed by the 25% pullback, and now today's sharp recovery. The excitement peaked when Navitas announced its 800-volt to 6-volt direct current power delivery board, designed specifically for megawatt-scale server racks. The structural innovation here is that it completely removes the traditional 48-volt intermediate bus stage that compute server trays have relied on for decades. By skipping that middle step, they hit a 97.5% peak efficiency, while shrinking the power component down to an ultra-low profile that is 20% thinner than a standard smartphone. This allows data center architects to pack GPUs closer together, which solves one of the single biggest physical engineering bottlenecks in modern server design: power density and thermal management. This is why the institutional desks at Fidelity Investments and major interactive brokers trading accounts took notice. If you can deliver higher switching frequencies and faster transient responses directly to a power-hungry graphic processor, you save massive amounts of electricity at scale. When you are talking about gigawatt-scale data center facilities, a 2% gain in power conversion efficiency translates to tens of millions of dollars saved annually in utility bills and cooling infrastructure. Yet, the moment the market digested this technical victory, reality set in during the subsequent sessions, leading to that sharp 10% sector-driven plunge. Investors realized that while these direct-cooled thermal management solutions and isolated through-hole packages for silicon carbide MOSFETs look phenomenal in a laboratory press release, the commercial ramp-up takes an immense amount of time. Navitas is currently operating at negative earnings, posting an earnings per share loss of over 62 cents on an annual basis.
Their recent first quarter report did show an 18% sequential revenue growth driven by these high-power markets, but the bottom line continues to burn cash at an uncomfortable rate. When an asset has no price-to-earnings ratio because it doesn't make a profit, the market gets highly sensitive to macro pressures. If interest rates remain sticky or if capital expenditure budgets among big tech firms face even a temporary pause, highly speculative component suppliers are the first to get cut from institutional portfolios. Professional asset managers using advanced platforms like the Interactive Brokers platform or executing large block trades through institutional fidelity brokerage channels will ruthlessly cut their high beta exposure the second the macro environment shows signs of strain. Comment below how many shares of Navitas Semiconductor you currently hold, or if you prefer trading larger semiconductor names instead. It is vital to gauge where the community stands on these volatile small-cap plays, because the retail footprint on this specific stock is incredibly high, with public and retail investors holding nearly 50% of the outstanding float. Now, to fully understand how Navitas ended up in this high-stakes position, we have to look back at what this company actually does and how its core business model has evolved over the past few years. Founded in 2014 and based out of Torrance, California, Navitas built its reputation on gallium nitride technology, commercialized under their GaN-Fast brand. For a long time, the investment help narrative for this company was entirely focused on the consumer electronics space. If you have bought an ultra-fast compact wall charger for your smartphone or laptop recently, there is a very high chance it was powered by a gallium nitride chip designed by Navitas. Gallium nitride allows power switches to run up to 20 times faster than legacy silicon chips, which means you can handle much higher power outputs while using components that are a fraction of the physical size. This legacy business allowed them to establish a massive footprint in mobile and consumer markets, particularly through manufacturing lines in Hong Kong and broader Asia. They built a solid portfolio of over 300 issued or pending patents, and even achieved a carbon-neutral certification, which made them a darling for ESG-focused allocation strategies on online investing platforms. However, the consumer electronics market is notoriously low-margin and highly cyclical. Wall Street realized that selling tiny power chips for smartphone chargers was never going to justify a multi-billion-dollar valuation, which forced the company into a massive multi-year strategic transformation. They acquired GeneSiC to bring high-voltage silicon carbide technology into their portfolio, allowing them to shift away from low-margin mobile chargers and move aggressively into high-power industrial electrification, solar energy, grid infrastructure, and electric vehicle drivetrains. Silicon carbide can handle massive voltages, up to 3,300 volts, making it perfect for the heavy-duty power supplies required to convert electricity from a regional utility grid down into the high-voltage direct current systems used by modern industrial hardware. This strategic pivot completely changed the type of investor tracking the stock. Suddenly, instead of being compared to minor consumer component makers, Navitas was being evaluated alongside major power semiconductor giants. This is why analysts at firms like Morgan Stanley, Needham, and Baird are so deeply divided on the stock, with price targets ranging anywhere from $12 to $21. The valuation models are completely fractured, because if you value them on their current financial strength, they look incredibly weak, with a profitability score that sits at rock bottom. But if you value them on their growth potential within the next-generation infrastructure landscape, the upside appears massive. This brings us back to the core storytelling tension between expectation and reality as we look toward the future outlook of this company. The prevailing market expectation is that the sheer macro demand for artificial intelligence hardware will lift all boats, forcing every single data center operator to buy wide bandgap semiconductors to keep their facilities from overheating. Retail traders loading up on fractional shares via their Robinhood app or setting up recurring micro-investments through online investment portals believe that the revenue explosion is right around the corner. But the reality is that Navitas is competing in a den of wolves. Major established players with massive balance sheets and deep institutional relationships are also aggressively developing their own gallium nitride and silicon carbide solutions. Navitas doesn't operate in a vacuum, and their lack of vertical manufacturing integration means they are highly dependent on third-party foundries to actually build their designs. If supply chain bottlenecks emerge or if global wafer capacity gets constrained, a smaller player will always get pushed to the back of the line behind mega-cap clients. Looking ahead, there are two distinct scenarios that could play out for this asset over the next 12 to 18 months. In the bullish scenario, the collaboration within the NVIDIA MGX ecosystem transitions from a showcase prototype at trade shows to massive high-volume production orders. If their direct-cooled power delivery boards become the standardized architecture for the upcoming waves of server rack deployments, their trailing revenue could scale exponentially, allowing them to finally cross the threshold into structural profitability. This would trigger a massive short squeeze and an institutional re-rating of the stock, forcing analysts to abandon their conservative hold ratings and driving a tidal wave of capital from Fidelity iRaise, SoFi active investing accounts, and major individual brokerage portfolios into the asset. Conversely, the bearish scenario is one where the commercial adoption of these high-voltage silicon carbide and gallium nitride solutions takes significantly longer than the market expects. If data center operators choose to stick with slightly less efficient but highly reliable legacy silicon architectures to save on upfront capital costs, Navitas will continue to burn through its cash reserves. Without a rapid surge in top-line revenue, the company might be forced to execute a dilutive secondary equity offering to fund its ongoing research and development, which would severely punish current shareholders. Furthermore, the persistent insider selling we have observed over the past quarter remains a massive red flag that cannot be ignored. When the executives who understand the exact timeline of these commercial contracts are aggressively liquefying their positions, it strongly suggests that the near-term financial results might continue to disappoint the market. In summary, Navitas Semiconductor represents the classic battleground stock, where the gap between narrative expectation and operational reality is exceptionally wide. Today's 8% surge to $22.21 shows that the market is still incredibly eager to buy into the high-power infrastructure story the moment any positive sector momentum returns. The technical achievements of their GaN-Fast and GeneSiC platforms are completely undeniable, and their strategic integration into next-generation server architectures proves they possess world-class engineering capabilities. Yet, as a pure investment, the stock remains an incredibly